Every morning, the headlines tell a dramatic story. Economy slowing, inflation reaccelerates, consumer confidence plunges, markets surge on optimism. The narrative shifts week by week, sometimes day by day. Yet inside many companies, the reality feels more nuanced. Sales may be steady even as headlines warn of slowdown. Hiring may pause even when economic growth numbers look strong. This contrast highlights a powerful theme shaping today's environment: the growing gap between economic headlines and business reality. Economic headlines are designed to capture attention. They compress complex data into simple narratives. A single inflation print becomes a sweeping statement about the direction of the economy. A monthly jobs report becomes proof of strength or weakness, but businesses operate on a different timeline. They respond not to one data point but to sustained patterns. This gap begins with aggregation. Economic data reflects national averages. It combines sectors that may be moving in opposite directions. Manufacturing may be slowing while services expand. Technology hiring may soften while healthcare hiring rises. A headline can declare broad weakness even as specific industries experience stability or growth. Business reality is far more granular. Companies see their own order books, customer inquiries, renewal rates, and supply chain dynamics. They track weekly revenue trends, not just quarterly GDP figures. Their decisions are shaped by direct engagement with customers rather than macro summaries. Another reason for the gap is lag. Economic indicators often reflect past conditions. GDP data is released after a quarter has ended. Inflation reports describe pricing trends from the prior month. By the time a headline circulates, many businesses have already adjusted. Companies are making decisions based on real-time data, not historical releases. There is also the role of sentiment. Headlines amplify emotion. Positive reports create waves of optimism. Negative reports trigger fear. Financial markets react quickly to these shifts. But companies with long planning cycles cannot pivot strategy every time sentiment swings. They require consistency in capital allocation, hiring, and operations. For example, a sudden stock market rally might suggest renewed confidence. Yet inside companies, executives may still be cautious about expanding headcount or launching new projects if demand visibility remains limited. Conversely, alarming headlines about economic slowdown may not immediately affect businesses serving resilient customer segments. Interest rates illustrate this gap clearly. Headlines often focus on central bank decisions and inflation trends. But business reality depends on how those rates translate into borrowing costs, refinancing schedules, and customer spending behavior. Some companies feel pressure quickly. Others, with strong balance sheets or long-term financing, feel minimal immediate impact. The growing gap between economic headlines and business reality also reflects sector divergence. Technology firms, industrial manufacturers, retailers, and healthcare providers can face entirely different conditions at the same time. A broad narrative rarely captures these distinctions. Supply chain dynamics further complicate the picture. Global events can dominate headlines, yet companies with diversified sourcing strategies may experience limited disruption. Others may face bottlenecks that never make national news. The lived experience of business leaders often diverges from macro narratives. Investor expectations add another layer. Public markets react to economic headlines rapidly. Stock prices fluctuate based on forecasts and sentiment shifts. But operational performance is built gradually. Revenue contracts, supplier agreements, and customer relationships unfold over months or years. This divergence can create tension. Executives may be questioned about economic risks that are not materially affecting their operations. Alternatively, they may face operational challenges that receive little headline attention. Navigating this disconnect requires clear communication and disciplined strategy. Technology has accelerated the speed of information. News spreads instantly. Social media amplifies interpretations. Market reactions occur in seconds. Yet, operational adjustments take time. Businesses cannot restructure supply chains overnight or retrain workforces in a week. The pace of headlines exceeds the pace of execution. Why does this gap matter? Because misalignment between perception and reality can influence decision-making. Overreacting to headlines can lead to unnecessary cost cuts or delayed investments. Ignoring sustained economic shifts because they seem abstract can leave companies unprepared. The most resilient organizations balance awareness with perspective. They monitor macro indicators closely but ground decisions in internal data. They stress test plans under multiple scenarios rather than chasing each news cycle. They maintain flexibility without sacrificing long-term focus. The broader economic environment reinforces this need for balance. Inflation trends can reverse, interest rate expectations can shift quickly, consumer sentiment can swing. Headlines will continue to evolve rapidly, but business fundamentals, product quality, customer relationships, operational efficiency change more gradually. The growing gap between economic headlines and business reality also reflects the complexity of modern economies. Digital platforms, global trade networks, and sector specialization create uneven impacts. A slowdown in one area can coexist with expansion in another. Companies that understand this complexity avoid binary thinking. They do not assume that one data point defines the entire landscape. They look for sustained patterns. They differentiate between noise and signal. Importantly, communication plays a crucial role. Leadership teams must explain how macro trends translate, or do not translate, into company performance. Transparent reporting reduces confusion. Clear guidance anchors expectations. The gap between headlines and reality is unlikely to disappear. Media incentives favor dramatic framing. Markets will continue reacting quickly. Economic data will remain aggregated.